Meantime, as I noted off the top of the show, we're just now under an hour away from the next update we'll be getting from the Fed. We can expect a few things, mainly a new policy statement, an updated dot plot, and a summary of their economic projections. But what else should we be looking for, be braced for when Jay Powell steps to the podium? For more on that, I want to bring on our next guest. That would be Danielle DiMartino Booth, former Dallas Fed advisor and CEO and director of intelligence for Quill Intelligence. She joins us now. And Danielle, I mean, when we look at this, what are you really going to be looking out for? Because a lot of people have said, Jay Powell's basically been out giving the updates as needed here. But is there anything specifically you're going to keep your eyes on for what might be important on where we go in the markets?
Well, I think, to your last segment's point, I think that Jay Powell and the market, I think, is expecting Jay Powell to talk up the uncertainty aspect, if you will, and talk down the economy. And that may sound a bit counterintuitive, but the fact is, I think that investors want to hear that there is nothing that is going to put the Fed into even flirting with being in a tightening mode. The market is priced in 3 solid years with no rate hike over the horizon. It's extraordinary to see that level. So there'll be a lot of scrutiny when they see for the first time what this summary of economic projections is going to be. You recall that March was an emergency meeting, so we didn't have that dot plot. So now we're going to look and see where do Fed policymakers see the unemployment rate and GDP headed in 2021 and 2022. So Jay Powell is going to have to answer for the dot plot for one thing, and he's going to have to answer for the president in another, and say maybe in his view this is not a rocket ship-shaped recovery. Maybe we need to be paying attention to those case counts going up in the 14 states that were just mentioned.
Yeah, when you talk about it, I mean, it does seem like it's muted the good news or the accommodative speech that you could expect here, considering the bazookas that the Fed's rolled out when we think about all the policies they've already announced. But when you look at maybe some of their expectations for year end on the jobs market, of course, we got the jobs report last week that really did fuel another jump here in stocks. But when we look at their year end targets, what are you going to be looking for in terms of maybe what the labor market might look like come the end of 2020?
Well, I'm really going to be curious to see what Fed officials feel is going to be that year-end unemployment rate, because it also happens to be the unemployment rate that coincides with Election Day. So, many of those who make up the consensus forecast are calling for 10% at year end. And I'll remind viewers that 10% is the post-war ceiling that we've seen on the unemployment rate, meaning at the end of the year, this economy will still be undergoing extraordinary strains.
Yeah, and as bad as it was, as you noted, in the peak of the Great Recession. But when we think about other policy tools at their disposal, a lot of Fed watchers are saying that it's probably too early for them to dip into adjusting forward guidance or yield curve control, 2 options that they haven't really delved into yet here. When we look into what could come on that front, are you in the same camp saying that they're probably not going to address those options on the table just yet?
Well, I was only there for 9 years, but given my experience, the Fed tends to have extensive presentations at a big FOMC meeting where they've got the summary of economic projections, and then they'll deliberate over the next several months. And I think the soonest that we'll hear something on yield curve control, again, depending on what the interest rate, depending on what the yield curve itself does, is September. So again, it's the forward guidance language that needs to be strengthened today. Jay Powell needs to hammer home that market expectations are in the right place, that the Fed is going to remain at the zero bound for as long as need be until the economy gains more traction.
Yeah, and you note that has been kind of the push there. I mean, the other big push that we've heard, at least it stood out to me when we've heard Jay Powell speak, has been kind of the stiff arm that he's giving on the expectations that more on the monetary side need to be pulled versus really pushing Congress to do more on the fiscal side. It's been a while since we've seen that last wave of coronavirus stimulus get passed and signed by President Trump. There's still a lot of debate going on in Washington. What would you make of maybe that push there by Powell to say, look, it's not so much as up to us anymore. Look at all we've done on the monetary side. And there's probably a good reason to really want and seek more stimulus on the fiscal side.
I think Jay Powell is grounded in what he's saying, even though I would prefer to see the Main Street lending program finally rolled out. We seem to get a new batch of details every week, but no actual action on that front. But to his point, Labor Secretary Scalia came out and said that he was not going to back extending that extra $600 a week in unemployment. Jay Powell's going to have a lot more work on his hands if we see the dormancy in auto loan delinquencies and in rental evictions start to kick up once that extra bit of stimulus expires by the end of July.
Yeah, and the last question I have for you, Danielle, is when we're looking at it, I mean, price stability and labor, and really supporting the labor market are the dual mandate for the Fed. And when we look at price stability, it's interesting because we haven't really seen inflation tick back up. Chair Powell has been very clear about how that has been running under the expectations here. Just lastly, I mean, when we think about those two things, maybe just focus in on price stability. What are your expectations on that front, since it really hasn't been the doom case that we even saw back in 2008 when inflation was supposed to be a runaway problem? Still haven't seen it despite all the actions taken so far.
So I dare say that Chair Powell should steer clear of any families right now who are being buried under 4% food inflation. And we've also seen oil prices come off their lows, which is going to show up at the pump. So if he does choose to stare into the inflation lens solely through core PCE, I think he's going to be missing a lot of the real on-the-ground inflation that families are experiencing right now, as we saw in this morning's fresh CPI data. So we can buy as many big screen TVs as we want, but the price of a gallon of milk has gone up a lot. And that's what's important to a lot of families right now, especially given that so many are making less in the way of income, even if they do still have their jobs.
That's a very good point. And it makes for a very interesting reason to tune in here as we approach that at 2 p.m. Thank you, Danielle DiMartino Booth. Always appreciate you taking the time to chat with us.